Welcome to the Good Divorce Show, where we can help you learn how to navigate the journey of divorce with less conflict, less debt, and equip you not to just get divorced, but also learn how to be divorced. Your host, certified divorce coach Karen McNenny, shares her wealth of knowledge, gets advice from other relationship experts, and interviews couples who learn how to have a good divorce, so you can too. Now here's your host, Karen.
Hello and welcome to the Good Divorce Show. I am Karen McNenny, your Good Divorce coach. And this is going to sound crazy, but I am so excited today because we're going to talk about taxes with Hubert Johnson. And Hubert is already giggling at me, aren't you?
Taxes can be fun.
Taxes can be fun. More importantly, taxes need to be talked about, and sooner than later in the process. Hubert comes with 15 years experience. He is a former tax professor, a lecturer, and has co-wrote 2 books. He also hosts a TV show called Taxes Made Easy that is broadcast every Monday through Friday in Texas and Louisiana. He has founded Guardian Tax Law. He has 5 kiddos between the ages of 21 and 10, has been divorced twice. He's also a coach for baseball and soccer, a referee. We love a well-rounded guest here on the Good Divorce Show. Welcome, Hubert Johnson.
Thank you for having me.
Well, can we start with the personal story? Because I think our listeners really appreciate knowing others like myself who have come through the fire of divorce, not once, but twice, and how that has informed where you're standing today. Give us a few highlights, if you would.
Well, law school is tough. And coming out of law school, I was preparing for the bar exam, and my first wife had a full-on mental break. So again, that was going through a fire. It was very, very difficult dealing with that. It ended up in divorce. We had 3 young kids, and she felt like she should be a full-time mother, even though she wasn't competent. And that wasn't her fault. It was just the situation. So, and when you talk about a good divorce, that was not a good divorce. That was anything but, because she couldn't understand why I was doing what I was doing. And again, very protective about her medical information, didn't want to share anything with me that she thought I could use against her. I was married for 9 years the second time, and unfortunately that led to a second divorce. That was more amicable. We didn't fight nearly as much over things, but again, it's still testy, and I wish people would learn that you don't have to fight. You can actually be good co-parents. And so I really believe in what you're teaching. And having been through it, I love to give people that advice. If you can work with your partner and work together, that's ideal.
Yes. And your story has a really interesting twist at the end, because you are remarried again now.
To my first wife. We've been remarried for 6 years. And honestly, it's so much better the second time around. We're more understanding. We've had to forgive a lot on both sides, and I think it's strengthened our marriage.
And 3 children from your original marriage to your current wife, and then 2 more children. Is that correct?
10 and a 13-year-old.
And which wife, what part of the story did those kids come into?
So my first wife, we had 3 younger children by the time I graduated from law school. And those are James, Joshua, and Jacob. They're all J names, all the boys. 4 boys, 1 girl. And so the oldest is 21. He's in Utah working. Second oldest is here in Arizona on a mission. And then my third is on a mission in Nebraska. So they're doing missions for the Church of Jesus Christ of Latter-day Saints.
Nice.
And then my 13-year-old and 10-year-old were my 2 children with my second wife. And they're in 5th grade and 8th grade. One plays soccer and referees with me, and the other one does ballet. And I had to tell her I could not coach her in ballet. She asked.
The one thing.
She asked, and I said, they don't want me.
I think it's good to know your limits, Hubert.
That's a pretty clear limit.
Well, let's dive in a little bit to this world of tax law and and how it applies to divorce. And I think this is an understated topic that people either
Yeah.
forget about altogether, or they stumble into it, or they don't think about it until there's a hot mess. So where do people tend to get it wrong? And where would you encourage people to start bringing taxes into the conversation?
Well, I loved your comment earlier. I wrote it down: sooner rather than later. I've had people come to me and while they were still married and said, "Look, he has tax debt. He's bringing that into the picture. How do I avoid becoming liable for that? How do I avoid having his tax debt affect me?" Great questions. I have been able to help people answer those questions. In one case in particular, it did end up leading to divorce, but it wasn't because of the tax issues. We were able to address that, give her peace of mind, and help them through the process of answering those questions. So if you have tax questions, we don't bill unless we're actually hiring you on as a long-term client to handle a case. We encourage call, get informed, get answers before you step into a landmine.
And generally, can you, I mean, that is such a generous offer. I'm taking your number down. Does it have to be you will reside in Arizona, and obviously each state has some particular tax laws, and then there's federal tax laws. So are you only fielding questions and clients in your local area, or does it expand beyond the Arizona borders?
Well, typically, and this is interesting because divorce law is very different state by state. When it
Mm-hmm.
comes to taxation, it's fairly consistent because the federal repercussions are consistent across the country.
Mm.
State tax law can vary, and it mainly varies based on community law. So depending on which state you're living in, there can be variances in how they're going to treat that, as whether or not it's separate property, or if you're in the western states mostly, then you can have community law apply, which can definitely change how the IRS looks at situations. So there's only two major differences. There are some exceptions within states, how they actually treat it. And so I work hand in hand with divorce attorneys to make sure we give the best advice to their clients and help them prepare for tax issues that they know that they're coming, or to avoid them in the first place.
In fact, you had a client who wanted to make sure that their former spouse um, didn't get negatively affected by their own tax debt. Is that true? Can you tell us more about that situation?
Yeah, absolutely. So we take clients as they come to us, and we try to work with their situation. And when there's a divorce situation, we represent married couples all the time, and sometimes they divorce due to the stress of tax law or other issues. But we represent both parties until a conflict of interest arises. If they're able to work together, we can still continue to represent them. And again, that depends on how well the parties can work together. But we have to be fully transparent. If there is a conflict, look, this is where this person is going, and we have to let one client go if that happens. In this case, it was a gentleman who had incurred taxes. They both filed jointly. So when I mentioned on that other case where we recommend that she file separately from her spouse, you can do that as married couples. There's a small tax penalty, but it made sure that the husband's tax issues did not affect her, even though they were married and filing taxes and living together while he was racking up taxes. In this other case, they had been filing jointly, and we were brought on board afterwards, after the divorce. And he wanted to make sure, he said that he was very frank about it. He said, the divorce was my fault. I'm the
Hmm.
one that blew it up, and I want to do right by her. She was remarried with someone else at the time, and we set up a resolution that would take care of both of them
Oh,
over time.
wow.
And we will absolutely do that. We just needed her information to include her in the case, and we didn't charge for that.
Wow.
Typically don't.
Let's just dive into this tax filing and review the options, together, married but separate, married but divorced. And if you could weave into this answer, as I'm working with families, especially whenever we're in the fourth quarter of the year, there is the question of, do we complete our divorce before the year is out and the IRS sees us as married for the whole year? Or do we Do we divorce on December 28th to make sure we don't have to file as married? Do we wait till January 2nd? There are pros and cons through the process and the timing that I think, of course, is going to be unique. But maybe you could give us some guidelines of what we should be taking into consideration when it comes to tax filing and timing and the timing of the divorce.
So it's always most beneficial to file jointly. In most
God
cases.
bless America, we love the married folk.
We do love the married folk. But if your partner is racking up tax debt and not addressing it, again, this avoids having to hire me. If you can avoid having the tax debt attached to your social, because it all follows social security numbers. So your tax account is based on your social, and when you're filing jointly, you have two socials on that return. And so both parties are jointly and severally liable. And this is a big trick. The IRS doesn't care what's in a settlement. They don't care who's responsible in any kind of agreement or what a judge orders. The IRS takes priority over state court judges. And so if you think so-and-so is going to pay this debt, they're going to assume responsibility for that, you're still on the hook in the IRS's eyes. So exactly. That surprises a lot of people. So that's why it's so important going into it that, first of all, it's better to never have it attached to your social. So if someone is messing up, they're messing up, keep those accounts separately. Another thing that trips up people is business debt. So if you were a member or working in a business, I've seen this happen far too many times, where one party is running the business, someone else is a secretary or receptionist, or they have some role in the business, and then both parties get tagged for that tax debt. If you have a partner that's not running a good business, you need to withdraw from that. You need to file separately. You need to make it clear that you have no connection to what they're doing. Otherwise, you can get stuck as the married partner, and it's hard to prove. It's easier to the more barriers you can show that, look, I have nothing to do with this, I'm not benefiting from this, you can protect yourself. But if you have someone that's running a business and not doing it well, and often in divorce, people don't know.
Isn't that the truth? I am astonished all the time of sort of the blind bliss ignorance of not being involved in what's happening with taxes, where money is, how businesses are being run. And then all of this starts to be illuminated during the discovery process of divorce. And there are some life shocks that come up.
And sometimes even after the divorce is finished, or a lot of times after the divorce is finished.
Yes.
So I was going to say something.
About not paying attention or not reviewing tax documents.
Exactly. I was talking to a financial advisor in a podcast, and I asked him, do you look at your tax returns, or do you just sign them? He's a financial advisor. And he went, you need to look at your tax returns before you sign them. And two, if you don't understand, have them explain to you. You don't have to be a tax genius to have a CPA explain to you what the consequences are. And if you're not comfortable with it, and you don't know what your spouse is doing on that tax return that you very well can be liable for, get a second opinion. Take it to your own CPA. Have someone review it. I can't tell you how many times Larry and Joe were buds, and he was their CPA forever, and then I got stuck.
Right. Yeah.
Yeah.
And there are partners who, prefer to keep their spouse in the dark and ignorant. And they'll just be like, it's all taken care of, just sign here. And as soon as you hear that, like, just sign here, those 3 words, then that might be a red flag that you do need to go and get informed. And if it feels overwhelming and frightening, then you call folks like Hubert, you call folks like me, and we will never shame you for wanting to get more knowledge.
And it's funny because my own wife, I was thinking about, do I just tell her to sign? I try to explain it to her, and she's just like, "Oh, I don't want to know."
Hopefully you're trustworthy.
Well, but that's the thing, though, and this is the hard part on divorce. It's built on trust. It's built on having those relationships. I've seen plenty of people, even when their partner isn't hiding information, someone gets sick, someone passes away, and the business isn't taken care of well. If you're not informed, if there's not a succession plan in place, I've seen plenty of people having to deal with their partner's tax issues after they've passed. And I've had wives cuss their deceased partner out to me because it's such a mess. It's such a headache. So when you're married, it is so important to know. Maybe you don't have to be the one that's next in line for the succession plan, but you should have people that you can trust that will guide you through that process. And if you're not informed at all, get informed. And if you get that resistance from your partner, that's a big red flag.
Yeah. Can you speak a little bit about innocent spouse protection? What it means, when it is, valuable, when it's something that we want to utilize it, and what could go wrong with that as well?
The biggest thing that goes wrong is people hear about it and they assume they qualify.
Well, tell us what it is as a starter.
So don't assume you qualify. That's my first message out there. It's his business. It's his mess. I don't know. I can just ask for innocent spouse. The standard is actually very steep to qualify for innocent spouse protection. So if that income came into the house, into joint accounts, if you see the money coming in and you benefited from the income, from the unpaid taxes, you will be held jointly liable. They won't grant innocent spouse status. You really have to be in the dark. The money flows through other bank accounts that you never see. You don't have any reason to know. So you don't know, and you have no reason to know about this income. So classic case that actually happened to someone in my family that's since passed, but they went through a divorce. And actually, the reason he was a trucker, and he came home, and his wife and son were both arrested for embezzling money.
Oh dear.
Oh dear. He would have gone to prison too, except for she had separate accounts. She passed all the money through that, and they could show he'd been on the road. That's why I didn't know, and he didn't benefit from any of it. I mean, the money was funneled around him purposefully and kept him in the dark. So he wasn't prosecuted. He didn't have to pay any of the penalties and fines that went with that. But again, the tax implications that came with it did not hit him at all. So that's an extreme example. But really, that's what they're looking for. If you know your husband, or it's typically the guys, sorry. But if you know,
me.
What's that?
You said it, not me.
It's just the way it is. But again, it can happen to both parties. But if you are seeing and benefiting from that money financially, it's hard to get that innocent spouse approved. Most of them get denied. And there are plenty of people, divorce attorneys, that just say, hey, just apply for innocent spouse. It's much harder to get. Don't assume you're going to qualify. And if you know about the debt and you're filing jointly with somebody, you will probably be held liable. So if there's something smelly, something fishy going on, filing separately can save you, can absolutely give you that peace of mind.
So what you're suggesting is through your marriage, and maybe for some people, because I think often we kind of know when things are going south before we actually pull the plug, that if you're having that concern, listeners, I think what I'm understanding you saying, Hubert, is rather than filing jointly, that even while you're married, you file separately, which takes those two Social Security numbers and puts them in kind of their own department. And that eliminates the entanglement. That's one place. Now, you may not get the same tax benefit, as you said earlier. Filing jointly is the best tax benefit. But if you feel like you have a spouse that is just moving a lot of money around, has big businesses, is not great in following through with their taxes, then you, in the long run, should anything come apart, the wheels come off the bus. You would be better off having historically separated or filing separate. Let me try that again. You would be better off filing married but separate taxes.
Now, and there are different classifications like head of household where you're still filing separately, but you're claiming head of household status. Only one person can do that. Talk to your CPA if you're in that situation, or a tax preparer that can make sure that gets straightened out. It's very important that you're filing correctly. But if you've been filing married, filing jointly, you can't go back and amend your returns and change that. That's one thorny issue. They don't want people to going back and say, oh, no, I don't want to be connected to him anymore, and changing past returns. So if you do suspect anything, filing head of household, married filing separate, you're just filing separate from his Social Security account, and that's where they're not going to go after both parties.
Gotcha. Now, one of the, again, together but separate benefits, household, all those things is when we've got kids involved. And, the tax child benefit on taxes is significant and potentially could change in the future. Every time we have the winds of Washington, D.C. blow through our communities, there's going to be changes. Would you talk a little bit about who claims the kids and what's the criteria for that and what happens when they turn 18?
So this is probably one of the biggest questions I get, and I can't tell you how many people call and they're mad and frustrated that so-and-so claimed the child when they weren't supposed to.
Mm-hmm.
So believe it or not, a lot of people don't follow the judge's orders.
Right.
Yeah.
So, because I've heard it's kind of first come, first serve. If you get your taxes in first with the claim, they're yours unless you want to go to court and get it all undone. So is that accurate?
It is, and the IRS will go through and eventually clear it up. But again, they're so overwhelmed in this department, expect it to be a year or two before they even get to your case. Oh. And if you're sharing joint custody, they're really going to leave it up to you and your ex-spouse to take it to court. So this is a common suggestion, and this might surprise you, that I give to people. If you have child support or alimony calculations, they take into account the child tax credits. And both parties, Trump and Harris, are both proposing increasing the child tax credit. But they take that into account in figuring out child support and alimony. So if there's going to be any kind of fight, or if you don't trust someone to not claim your kids in the future, or if they start doing it, go back to court and say, okay, great, he wants to claim them. Let him claim them. And then let's change child support to take that into account. Let's change those numbers. And that's a much easier way of doing it. The frustrating part is if you have a deadbeat parent that has no income, isn't paying child support, that's a completely different issue. You can't squeeze blood from a stone.
Sure.
But that's where you might want to file with the IRS. And I mean, if they don't have any income, it's not going to benefit them anyway.
Right. You can't get the blood out of the stone, so they say. So, in a best case scenario, we've got two parents, there's no child support being paid, it's 50-50, everyone's been contributing, they alternate years. 1 year I claim our child, 1 year you claim the child, it goes back and forth, that kind of equalizes. Now 18, there's no longer really a parenting plan or jurisdiction over that, is my understanding, but kid's still in college, kid is still being supported. And maybe that's when the teeter-totter, if you will, starts to shift and one parent starts to do more. What does it look like on the other side of 18? What's the guideline of who then should get to continue to claim that child?
The guideline is whoever provides 50% or more of their support.
And that can be tuition, housing, gas money. Oh.
Now, the credit goes down to around $500. I believe that's it, for dependent over 18 that you're claiming. So if you're not getting the child tax credit, you can still claim them as a dependent. And the dependency rules are actually fairly broad as to who you can claim as a dependent. It's not just family members, but you have to be providing 50% of their support to claim them. And it's just a much smaller benefit, but there's no limit on age. I have clients that claim grandparents as dependents.
So claiming a dependent is different than claiming to get the child tax credit.
Absolutely.
Okay, this is why we have the Good Divorce Show, listeners, is because little smarty pants like Hubert Johnson comes on and like, oh, I didn't even know this was like, we don't know how taxes work. We're just a bunch of blind, feeling around in the dark ding dongs out there. So that's a distinction. Can you both claim, can both parents each claim one child as a dependent? You still have to take turns?
So their social security number can only go on one tax return.
Okay.
You can take turns year to year, but a lot of times I recommend against doing that if there's any tax issues that need to be resolved. So again, if someone's claiming the children and you go back and forth year to year, the IRS looks at a household and who are you claiming as dependents and figuring out what kind of resolution they qualify for. So there are times where I'll recommend, hey, just let them claim them, pay more on child support, whatever, it'll wash out. Or if you can claim them and just pay them a little extra money, whatever, it can really help you in resolving your tax case with the IRS. It can make or break cases.
Wow. Well, listeners, we are having a riveting conversation today with tax lawyer Hubert Johnson. We're going to come back with some more questions to fill in the blanks on a topic that so many of us are really underskilled and misinformed. So stay tuned. I am Karen McNenny, your Good Divorce Coach.
Are you thinking about getting divorced? Before you call a lawyer, call the Good Divorce Coach, Karen McNenny, a certified divorce counselor, co-parenting specialist, and mediator. Karen's signature Good Divorce experience will guide you through your divorce journey from the day you make that difficult decision to the day the decree is signed, all for a predictable fee. The Good Divorce Coach will teach you and your partner how to get divorced and be divorced with less conflict and less debt. Visit thegooddivorcecoach.com to get in touch with Karen.
Now, back to the show with Karen.
Welcome back to the Good Divorce Show. Thanks for sticking with me, listeners. Today we are chatting with Hubert Johnson. Hubert has been practicing tax law for 15 years. Not only is he a divorce survivor, he's a smarty pants when it comes to thinking about your taxes as you navigate your divorce, which is a topic that most of us don't understand, and therefore we don't always give it the attention that it needs. So thank you again, Hubert, for joining us from your company, Guardian Tax Law, located in Arizona. I want to dive right back in to talk about business and the sorts of things that we need to be aware of. And that's everything from when we're paying our taxes, when businesses need to be divided upon divorce, bankruptcies that might be happening, selling, valuations. Let's just go all business nerd for a moment.
Well, you just mentioned a lot right there.
I know.
It's like
I
4
want
topics.
it all.
Okay, so business ownership. Again, I mentioned earlier, if you are a partner or in business with your spouse, it's treated very differently than if one person owns and runs the businesses. It all carries through to your personal returns, though. So if you're filing your personal returns jointly and there's debt onto that business, be very aware of that. You want to either step away, start filing separate returns, but for past returns, you very well might be on the hook for those returns. There's quite a different phases of business ownership. Be informed. That's my best advice. Be informed, and when you have questions, ask early. And find out what's going on with the taxes. One of the big concerns out today, and this is something that I've been hammering home, and attorneys, they always warn of everything because we're there to protect people. We make horrible business people because we always want to safeguard against everything. But one thing to safeguard against, and this is a bigger issue this year, Congress, in their great wisdom, sarcasm, and a very bipartisan manner, raised the interest rate that people are getting charged with from 3 to 8% in 2024 for not paying enough taxes within the given year.
Wow. That is significant. 3% to 8%. And what you're saying is if you're not paying your estimates to schedule or in the full amount, you're going to get a bigger ding when you go to file your 2024 taxes. Okay.
And that's on top of all the other penalties. So it's if you have a business, but also if you're not withholding enough, you could be a W-2 employee and not paying enough in taxes and still get smacked with this penalty.
Wow.
So we mentioned sale of assets. Again, when you go through a divorce and there's a division of assets, when you get these large sums of money, it is important that you pay the taxes then and there. If you wait till the end of the year and you had income earlier in the year, you can get hit with this penalty. So this is something I'm trying to raise the alarm about. So if you have a business, how do you know how much to pay in estimated tax payments? There's a couple safe harbors. So if you're under 110,000 in adjusted gross income, you can pay 90% of the tax from the previous year. I'm sorry, I think that's 150,000. If it's over 150,000, you have to pay in at least 100 or 110%. So talk to your CPA. Make sure you're following the right calculations. This is something a CPA handles. I don't prepare taxes. I just know this is an issue that affects people, and I see the results of it. But big suggestion here, if you or your partner don't know what your income is, you have no idea because you don't do a profit and loss until the next year, and we're coming up on the extension date. A lot of business owners don't get a good handle on what they did until they're 9 months into the next year. So we're coming up on the extension deadline. Business returns were just due on September 16th. But that's a look back to 2023. How do you know what to pay in 24 if you're not staying on top of your books? There's QuickBooks, Dave Ramsey has programs. There's plenty of programs out there to manage your books on a regular basis. And if you're concerned that your partner isn't paying taxes or isn't paying enough in taxes, it's all about the estimated tax payments that are due quarterly at least. And I just talked to someone. He said, look, I can't pay my taxes because I get the money, it's gone. The IRS will always take your money early. So if you get a large sum, you should pay the taxes on that before anything happens with the money. And you're laughing because you probably see this all the time, Karen.
And I love the government's always happy to have our money as soon as we're willing to give it to them. And I know people are like, I'm going to keep that to the last minute because that's my money and I'm making earnings on it or whatnot. But what you're identifying is there really could be big penalties and consequences for making that choice.
At least 8%. And that's if by April 15th you file on time, you pay everything on time. If you haven't made those payments throughout the year, it's an 8% penalty on top of any other penalties that might be out there.
Wow. Now, what if there is a bankruptcy kind of in the middle or leading into a divorce or as a result of the divorce? Can you give us this is probably a podcast all by itself, but what are the things we should definitely be paying attention to if we find ourselves facing divorce and bankruptcy somewhat simultaneously?
So when it comes to taxes, the last thing you want to do is have your partner file for bankruptcy and leave you holding the bag.
No kidding.
Happens all the time.
Oh, breaks my heart.
So couple things to know about bankruptcy and taxes. And I'm not a bankruptcy attorney and I refer cases out to bankruptcy attorneys all the time. But, and the rules are different per bankruptcy jurisdiction and they have different districts across the country. So the rules in one part of the country are different, but in general, you can't discharge tax debt until it's been filed for at least 2 years. So the debt has to be assessed, and then 2 years after that, then it can be included in a bankruptcy. That's not a hard and fast rule. They have different rules. There's a 240-day rule in some jurisdictions. So it depends where you are in the country. But in general, if you're getting caught up and filing a bunch of tax returns, those can't be included in the bankruptcy until you give enough time. And usually people are filing returns to then qualify for bankruptcy. That tax debt won't be included in the bankruptcy, won't be discharged. It can be included in a Chapter 13 where you're doing a repayment plan. That's a little different. So that's the number one thing to watch for. Number two, a bankruptcy applies to the social, just like the tax accounts with the IRS. One person files for bankruptcy and the tax debt is discharged under their social, the IRS will go after the other person. It's you still have to deal with these. So if your partner's filing for bankruptcy, be aware. I would be very mindful that he's discharging that debt, and you might want to be very careful and how you might be stuck with some debts that you're jointly liable for, and consider that when doing any kind of settlement agreement.
Now, you know what I want to say at this moment, Mr. Johnson, is that I don't have to worry about these things because my attorney, my divorce lawyer, and the judge, they're going to watch out for all of this and take care of it for me. True or false?
Absolutely false.
I don't like that answer.
So there's a joke in law school that if you can do math and science, you don't go to law school.
Hey, wait a minute.
We're good at arguing. We're good at researching cases. Most attorneys are not good at math.
Wow.
And you would think, oh my goodness, most divorce attorneys that I've talked to have a clause in their contract that they don't give tax advice.
For this very reason.
For this very reason, and expect judges to not get it right. I've actually written opinions that have been sent to judges. We've done the legal research and submitted to a judge, an experienced judge, but say, hey, this is the law, this is the tax law, this is how this should be applied, and this is why it should be ruled in our client's favor. And we're very successful in doing that. But don't assume your attorney and the judge are not familiar with tax law. They're probably not. And again, judges specialize. One of the funniest things I ever saw was I was dabbling in family law. So I was in a hearing, and a corporate attorney came in and tried to argue his case in front of the judge. And all the attorneys in the back were elbowing each other. Haha, look at this guy. He blew up his own case because he might have been an amazing corporate attorney, but he didn't know squat about family law. So when you get into these tax and math issues, make sure that your attorney is familiar with the math numbers, or bring on an expert. We do consult. We don't charge for a whole fee just to consult on a case, but especially to make sure you're not going to get burned by tax issues. Most judges, most divorce attorneys are not good at math. Absolutely not.
So here's another area that is mathematical that comes up with the families that I'm supporting, and it's the division of retirement accounts. We've got 401ks and IRAs, maybe even 529s that coexist for the kids, and some are pre-tax, some are tax deferred. Can you just unpack again some of the big categories and the questions we should be asking and who we should be asking them of when it comes to retirement?
Again, the retirement issues can be very, very, it depends on the type of retirement account, but this is why when you're in divorce court and you get into math heavy areas, the family law courts use experts. So for quadros, division of retirement assets, business valuations, they use attorneys that specialize in business valuations, and it can really make or break a case to do a good business evaluation and get a good attorney on board for that. When you're looking at retirement accounts, people look at the numbers and think, oh, okay, this is he has 100,000 in there, I'll get 50,000 and walk away. Absolutely not. When you cash that money out, it's usually a taxable event unless you roll it over immediately. And when she mentioned pre-tax, post-tax, it depends on whether or not taxes were paid on that item in the beginning. So, for example, in normal 401ks, IRAs, the advantage is that the money goes in pre-tax, which means you don't pay taxes on it. And then it accumulates over time, and that's the value that you don't have to pay taxes on it. It reduces your AGI in the year that you're paying taxes on. So there are benefits to it. But because taxes were never paid on that money, when that money is distributed out, it's a taxable event unless you avoid it. And you can get hit with some pretty nasty penalties. And a lot of people take that money, they use it for a new house. They only use it for some needs because there's a lot of needs when couples divorce.
Right.
I mean, people need new cars, new furniture, you name it.
Mhm.
But you need to pay the taxes first. Pay the tax man first to avoid that issue. You follow this advice and you won't have to hire me.
Yes.
So,
We might need you to translate like AGI, a
good
adjusted
point.
gross income, right? It's your native speaker of these things,
Very true.
and the jargon it does you don't even think about it. But most of us are listening and like, okay, wait, there was an IRA, a 401k, and again, there is no shame, listeners, in becoming educated. We enter our adult life grossly undereducated in a lot of the things that we need as adults, like how to do a good breakup, how to do our taxes, how to understand how retirement accounts work. So become educated. So just to give a mathematical example that helps me because I'm not a mathy person, let's say there's a $10,000 sitting in a retirement account and my spouse says, you can have that, Karen, right? Here's the teeter totter on the settlement. We're going to make this equalized. And I'll take the $10,000 in the bank and you can take the $10,000 retirement account. What are the pros and cons? What should I be watching for?
So money in the bank is usually post-tax. Taxes have already been paid on that.
Right. So 10,000, that's actually
That's
what it
cash.
is. That's cash. 10,000 in my IRA.
So, in an IRA or 401k, and I'll explain how this affects AGI. So, if you take that 10,000 out, that's a taxable event. So that means that money is now going to be taxed and added to your adjusted gross income. So when you do your taxes, you do your gross income, and then you subtract out the deductions, the standard deduction or itemized deductions, and that comes out with your adjusted gross income, and that's what you have to pay taxes on. If you get 10,000 out of an IRA or 401k, that money hasn't been taxed yet, so then you get to pay taxes on it. And let's say you're right at the cusp. Let's say you're at 120,000, or I'm sorry, I think it's right around 90,000. So let's say you go from 90,000 in AGI to 100,000, it can bump you up in the next tax bracket. So you'll actually pay a lot more on that $10,000. You can pay, I think it's 22% for that bracket. And so that $10,000 is only worth $88 or $7,800.
Right. I want everyone to hear that. The 10,000, which is what you think you're getting, and it all looks even Steven, is actually only worth 7,800. And again, that number might change depending on your tax bracket and a lot of other factors. But what we want you to recognize is that you have to look at every form of asset in that settlement, because it might be a car, it might be a house, it might be a retirement account, it might be cash in the bank. All of those are going to kind of come out what I call the Play-Doh fun factory of money, and they might look different on the other side.
They can look very different on the other side.
Mm-hmm.
So again, a Roth IRA, and this is the main distinction here, it's in a retirement account where you pay the taxes on them. So it counts as income, but you put into a Roth IRA, but because that money's already taxed, the increase and the growth off of that isn't taxed. And so right now, we're talking about election. A lot of people are advising their clients, your taxes might go up. If Harris is elected, she's promised to get rid of most of the Trump cuts, especially for those making over 400,000. And a lot of people are investing as much as they can in Roth IRAs to take advantage of the lower taxes that we have currently. And especially if we don't fix our budget, if we continue to owe money long term, if our national debt explodes, taxes will go up dramatically. So putting that money away, paying the taxes on it now, getting it post-tax can save you a lot of money in the long run.
Great advice. And by way of context, listeners, because this is an evergreen conversation, Karen and Hubert, we will be talking into the future when this lives out there on the interwebs, but it's the fall of 2024. And it is, as we always say, historical times.
Yeah.
Hubert, as we begin to wrap up our conversation today, what advice, words of wisdom would you pass on to our listeners as they begin to take into consideration their own financial future as they navigate the complexity of divorce?
Get good experts around you.
Mm-hmm.
If you don't like what you're hearing, get a second opinion. And do your due diligence, look them up, check out who you're talking to, be informed. I have people that come in and say, I like you, you have a lot of knowledge, you have a great history. I'm like, well, still check me out. Don't trust what's coming out of my mouth. Look at my credentials, look at my reviews, see who I am. And if you go and you talk to someone and you feel like you're just entered a high pressure sales pitch, go somewhere else, get a second opinion. But it's so important to get people that will give you some free advice. They're not going to nickel and dime you at every turn, because you want to have that ability to go and to talk to people. And there's plenty of times I say, look, this is a CPA question. Go talk to them. I would be a little wary of someone that tries to be an expert in everything.
Yes,
but again, there are plenty of excellent professionals out there. Start making those connections, getting someone you can trust. And especially if you have a partner that's buddy with them, a family friend, they might be more their friend than yours. And that can and does burn people on a regular basis.
Speaking today with Hubert Johnson, founder of Guardian Tax Law, tax accountant, likable nerd. And I want you to remind us where we can find you and the TV show and the books. Where are your resources, Hubert?
So absolutely. The book's only one is published, and it's was published under someone else's name. So I don't get anything if you buy that book, but it's all my stories, all my experience. But our phone number is 520-485-7371. And if you get IRS letters, if you have questions, we give free advice out all the time. And so you can always call, share your story, and we'll either refer you on to someone that can help you out or give you some advice and be that resource for you. And that's how we're trying to position ourselves. Our website is guardiantaxlaw.com. You can find our show either there. We have a YouTube channel right at the top where you can see all of our shows that we've done, or you can go to smartmoneyculture.tv, and they're broadcast twice every day. And again, it's up-to-date news, tax news, and different tax topics every single day on how to help people. And we really do believe in that ideal of making taxes easy for people.
And that indeed is the name of the show, Taxes Made Easy. Thank you so much, Hubert, for spending this time, resources, and I really appreciate meeting another professional who is so aligned with the mission here of the Good Divorce Show, providing as much information as possible, not out to nickel and dime you, trying to help each and every one of you find your way through the divorce with less debt, despair, and destruction. Thanks, Hubert.
Thank you, Karen.
And remember, listeners, everything will be okay in the end. And if it's not okay, it's not the end.
Thanks for listening. Do you have questions or thoughts about this week's episode? Let us know by following the Good Divorce Coach on Facebook and Instagram at Good Divorce Coach. And leave a comment. And be sure to tune in every Monday at 10 a.m. Pacific or listen anytime wherever you get your podcasts.